Hello, I am Emily, and I am going to be starting us off with our presentation from Group 5. We are going over the Coca-Cola Company, providing an unbiased investor analysis. The Coca-Cola Company started in 1886 and runs from Atlanta, Georgia. It sells products in more than 200 countries, which makes it the largest non-alcoholic beverage company in the world. The mission is to refresh the world and inspire moments of optimism. The vision has moved forward toward what the company calls a total beverage company. It now pushes beyond soda into water, coffee, and sports drinks. Watch that pivot because it shapes the numbers throughout our analysis. In fiscal year 2024, Coca-Cola brought in $47.1 billion in net revenue, up 3% on an organic basis. This gives us a large, globally diversified business to weigh as a debt or equity investment. These figures come from Coca-Cola's company website and its 2024 Form 10-K. As I mentioned previously, Coca-Cola sells far more than its flagship soda. The sparkling line includes Coke, Sprite, and Fanta, or Fanta, depending on where you come from. Water and sports drinks include Dasani, Powerade, and Body Armor. Juice and dairy run through Minute, Simply, and Fairlife. Coffee and tea come from Costa and Gold Peak. The range supports the total beverage company vision. 3 competitors matter most. PepsiCo sits closest, though its snacks business gives a far wider base. Keurig, Dr. Pepper, and Nestle compete in specific categories. Now the strengths. Coca-Cola owns one of the most valuable brand portfolios anywhere, runs a deep distribution and bottling network, and holds pricing power that lets it raise prices through recent inflation while keeping volume. The risks cut the other way. Regulators target sugar and health, commodity and input costs squeeze margins, a global footprint exposes earnings to currency swings. Water sourcing poses a long-run supply question. These factors set up the financial analysis my teammates present next.
In the next 3 slides, we will be comparing Coke and Pepsi using 10 financial ratios to show where each company is stronger. On the slide, we'll be comparing Coke and Pepsi across profitability and liquidity. Starting on the left, Coke is clearly leading in net profit margin. Coca-Cola is at 27.4% compared to Pepsi at 8.8%. This means that Coke keeps more profit from each dollar of sales. Pepsi may bring in more total revenue, but Coke does a better job turning sales into profit. Return on equity is much closer. Coke is at 40.8% and Pepsi is at 40.4%. This shows both companies produce strong returns for shareholders. The difference is how they get there. Coke is more margin driven, while Pepsi's return is helped by higher leverage. On the right side, we look at liquidity. Coca-Cola has the stronger current ratio at 1.46 compared to Pepsi at 0.85. Coke's quick ratio is 0.79 compared to Pepsi at 0.64. This shows Coke has better short-term coverage. The takeaway is simple. Coke leads in profit margin and short-term coverage, and Pepsi is still strong, but they operate with tighter liquidity. This slide, we're looking at efficiency and leverage. Starting with efficiency, Pepsi is stronger. Its asset turnover is 0.87 compared to Coca-Cola at 0.46. This means Pepsi generates more sales from its asset base. Pepsi also has a higher inventory turnover at 7.37 compared to Coca-Cola at 4.16. So that means that Pepsi moves assets and inventory faster. This fits the business model. Pepsi has a wider food and beverage operation, so product movement and volume matter more to them. Coca-Cola is still efficient, but it is more focused on brand strength and margins rather than moving as much physical product. On the leverage side, story is split. Coca-Cola has lower debt to equity at 1.37 compared to Pepsi at 2.41. This means that Coke uses less debt relative to equity, so it has a cleaner leverage position. However, Pepsi has stronger interest coverage at 10.3 compared to Coca-Cola at 8.32. This means that Pepsi carries more debt but still generates enough operating income to cover the interest better. So, takeaway is simple: Pepsi wins operating speed, Coca-Cola carries lower leverage. On this slide, we are looking at market value ratios and the overall position for both companies. Starting with the price to earnings, Coca-Cola is at 23 times, while Pepsi is at 24 times. These numbers are very close, so investors appear to value both companies at similar earning level. In simple terms, the market is paying about 23 to 24 times earning for both companies. The bigger difference is the market to book. Coca-Cola is at 15.3 times compared to Pepsi at 9.7 times. This shows that Coca-Cola has a stronger market premium beyond book value. That's likely reflects Coke brand's strength, stronger margins, and investor confidence. Looking at the overall picture, Pepsi is best at asset turnover, inventory turnover, and interest coverage. That tells us that Pepsi is more volume driven and has faster operating model. The Coca-Cola is best at profit margin, liquidity, lower leverage, and market to book. That tells us that Coca-Cola is more margin driven and financially cleaner. The main takeaway is that both companies are strong, but they create value differently. Pepsi wins on the operating speed, while Coca-Cola wins on financial strength and market premium.
Capital structure and governance for Coca-Cola. The debt amount of $44.65 billion includes total debt, which is short-term borrowings, commercial paper, and current maturities of long-term debt. For equity composition, the common stock sits at $337.2 billion and $340 billion, with share price trading around $83.50, based on the outstanding common stock of 25 cents par value and retained earnings. As for bonds and equity offerings, in early 2026, Coca-Cola traded in its short-term debts for long-term senior bonds, mostly in euros, with interest rates between 3.3 and 4.0. They did this to keep their interest costs low and locked in fixed rates. There has been no equity offerings, which means the company's massive cash reserves does not need to sell new shares to fund its operations. Instead of issuing new equity, management focuses on share buyback programs, which protect investors and current investors from dilution and increase value of existing shares. Capital weights of 89% from market equities, so the total value of all their stocks on the market, and 11% from debt. Although they have billions of loans, their stock market value is massive, making the debt look small. Cost of equity of 7.62 to 7.70 shows Coca-Cola is stable and investors don't demand a massive return to buy. After-tax cost of debt of 0.70 to 2.40 gives the company a low interest rate because Coke is safe, so they don't have to deduct interest expense from their tax. Tax rate of 14.90% demonstrates the tax shield drop from their actual cost of borrowing more. So the calculated WACC is between 6.90 to 7.44, which means if the company wants to produce a new drink or create a new line of business, the project would have to generally generate roughly around 7% of time and money. If it's less, then they would lose money. Compared to Pepsi's number between 6.20 and 7.50, as well as the industry mean of 8. It means that Coke's rate is lower and they can take on more projects that the competitors cannot take on, which leads to cheaper growth, higher project margins on investments, and a safety cushion.
Coca-Cola is a great example of how environmental issues can create agency conflicts inside a company. Managers are under pressure from environmental groups because Coca-Cola has repeatedly been named the world's largest plastic polluter. That puts the company's reputation at risk, so managers often prioritize sustainability initiatives, public relations, and long-term environmental goals, like increasing recycled content and packaging by 2035. But shareholders don't always see it the same way. Plastic packaging is significantly cheaper to produce and transport than alternatives like glass or aluminum. Lower costs mean higher margins and higher returns. So while managers may want to invest in sustainability to protect the brand, shareholders may prefer cost-saving strategies that maximize short-term profitability. Coca-Cola's ownership structure is dominated by institutional investors who collectively hold over 68% of the shares. Berkshire Hathaway and BlackRock Inc. are the two largest shareholders, with 400 million and 333.6 million shares respectively. Insider ownership is relatively low at 9.9%, which is typical for a mature global corporation. This structure means governance influence is concentrated among large institutions rather than executives or insiders. For the 5-year annual return, we use a CAGR formula, which measures Coca-Cola's average yearly growth over the past 5 years. Based on the beginning and ending adjusted close prices from Yahoo Finance, Coca-Cola produced a 5-year annual return of 32.92%, showing solid long-term performance. For risk, we use the 5-year monthly beta, which is 0.55. A beta of 1.0 means a stock moves in line with the market, so a beta of 0.55 means Coca-Cola is about 45% less volatile than the overall market. This tells us Coca-Cola is a low-risk, defensive stock that tends to move more steadily even during market swings. Overall, Coca-Cola offers a combination of strong long-term returns and lower than average risk, which aligns with its reputation as a stable consumer company. Coca-Cola is known for its strong dividend history. The company pays quarterly cash dividends, with most recent payment being about 53 cents per share, or roughly $2.12 annually. Coca-Cola is also considered a dividend king, meaning it has increased its dividend for more than 50 consecutive years. This long track record shows the company's stability and commitment to returning value to shareholders. On the debt side, Coca-Cola has approximately 44.56 million bonds outstanding across multiple currencies, including US dollar notes, euro notes, Swiss franc notes, and debentures. This reflects the company's global financing structure. For our selected bond, we looked at the issue with QSIP 191216DZ0. This bond has a 5.20 coupon rate, pays $26 every 6 months, and matures in 2055. Its current yield to maturity is 5.51%, and it trades about $95.51, which is below par value. That discount is why the yield to maturity is slightly higher than the coupon rate. Overall, Coca-Cola provides steady dividend income and maintains a diversified, long-term bond structure that appeals to conservative, income-focused investors.
Let me bring the team's analysis together into a clear recommendation. Our overall call on Coca-Cola is a hold with a moderate buy for income-focused investors. On debt repayment, KO is in excellent shape. They hold $13.4 billion in cash and generate roughly $11 billion in annual fee cash flow. Their current ratio is 1.14 times and interest coverage is 11.7 times, meaning they cover their debt services nearly 12 times over. With $42 billion in long-term debt against a market cap north of $337 billion, there is no material default risk here. For future funding, the math clearly favors continuing to use debt. KO's WACC comes in between 6.9 and 7.44%, which is below the 8% industry median. This the after-tax cost of debt is as low as 0.7% compared to a cost of equity around 7.6% via CAPM. Issuing new equity would be significantly more expensive and would dilute existing shareholders. Our recommendation is to continue tapping the investment grade bond market through the EMTN program. Finally, where does KO fit in a portfolio? The numbers tell a compelling story for the right investor. A beta of 0.55 means KO moves at roughly half the volatility of the broader market, making it an ideal defensive anchor alongside higher risk growth positions. The 5-year CAGR of 32.92% is strong, and the key here is that this return came with significantly below market volatility, which is a rare combination. As a dividend king with 65 consecutive years of increases, KO pays $2.12 per share annually and has never once cut that dividend through recessions, pandemics, or financial crises. Our overall verdict, Coca-Cola is a financially sound, well-governed, shareholder-friendly company. It is best suited for conservative and income-focused investors who want steady, reliable returns with below-market risk. Thank you very much.